Hey, Dr. Joe's in the house on this Wednesday evening. Very, very cold here in the Washington, D.C. area. Snowing. We had about, I think, 9 inches of snow this weekend. So it's pretty bad, but all good things. Hopefully, it's not too bad where you are. And so we got another live um, Wealth Wednesday. So hopefully you're doing good. And I had a wonderful Christmas and New Year. I certainly did. And looking forward to today's session. Well, it's all about the money. It's going to talk about building relationships with banks and financial institutions. Obviously in real estate investing, we need money. It doesn't always have to be your money, but it's got to be money from somewhere. And the reality is that most of the money these days come from financial institutions, banks, hard money lenders, DSCR lenders, and so forth. So I thought it would be appropriate to talk about building relationships with banks and financial institutions. How do you do that? How do you go about it? Strategies, do's and don'ts, and just sort of learn from some of my experiences that I've done over the years. So that's what we're going to talk about today. Building relationships with banks and financial institutions and so on. As usual, if you got some questions, please put them in the chat box, and I'll get to them in about 20-25 minutes from now. And as always, if you want to book a one-on-one with me, where we can do a deep dive into any topic that you want to delve into on real estate related, either a deal that you're looking at, financing a deal, rehabbing a deal, tenants, and so forth, book a one-on-one with me. Go to my website, www.joeasimo.com, www.joeasimo.com, and you can schedule something with me. They're usually very, very good sessions. And my goal is that for every dollar you spend, you get $5 back in terms of value and so forth. So anyway, so let's talk about building relationships with banks and financial institutions. And so the reality is that, if you've ever struggled to secure financing for a great deal, only to lose out because you didn't have the right lender on your side, then that's what we're going to talk about today. So this is a reality for a lot of people, myself included in the past. And it's painful that you got a good deal, it's a good deal, the numbers seem to pan out, and but you're having a hard time getting the financing together. Lenders taking too long, lenders asking too many questions, they're asking for more documentation, all that stuff. And next thing you know, you can't close, and therefore the deal's gone. Somebody else comes in, swoops it up, just because you're unable to execute. So building strong relationships, with banks and financial institutions isn't just about getting a loan. It's about creating a foundation, in my opinion, for long-term success. Lenders who you know and trust, they know you, they know what you're trying to do. You establish the foundations together. They can typically offer you favorable terms, faster approvals, and sometimes tailored solutions that makes more sense to you, that align with your investment goals. So in today's competitive environment, it is a competitive environment out there. There's still, there are not a whole lot of deals, but there's still a lot of people looking for deals. These advantages in terms of getting your financing together can set you apart, from others. Hold on a second, just turn my mobile phone off. And so that's the idea, is to differentiate yourself from other people because you can execute. Not everybody can. And if you can do that, you can scale your portfolio, and you can gain access to deals that other people can't do. And also you can implement the BRRRR strategy, which is the buy, renovate, rent, refinance, repeat strategy, easier. So that's what we're going to talk about today. And how do you go about doing that? And the essential steps, the do's and don'ts based on my years of experience of doing this thing. So let's get down. I broke it down to 6 parts. So number 1 is what makes a strong banking relationship. So what do I mean by a strong, banking or financial institution relationship? I suppose the question is, how can investors like you and I establish trust and rapport with lenders? How can we establish rapport and trust with lenders so that they'll borrow us the money, give us the money, show me the money when the deal comes by? So a strong banking relationship starts really, in my opinion, with transparency and and reliability. You put your cards on the table, your situation, and they're putting their cards on their tables in terms of what they're looking for. And they have to feel comfortable that you're going to be a reliable partner. You're going to pay. You're going to do what you say you're going to do, and per the terms and the agreements that the bank's going to offer you. So lenders want to work with investors who demonstrate, I think, professionalism and have a history of financial discipline. They've shown that they can handle money. They've shown that they can handle debt. They've shown that if credit is extended to them, they can manage that responsibly and reliably, and so on. So providing clear and accurate financial documents, maintaining consistent communications, and honoring your commitments, I think, are key to building trust. Okay, it's all about trust. If they trust you, then they're more likely to borrow money to you. If they don't trust you, then it's going to be very, very difficult, almost impossible. Nobody wants to give money or borrow money or lend money to somebody who's not going to pay them back or not do what they say they're going to do. So this trust lays the groundwork for future collaborations and ensures that the lender is more likely to prioritize your needs and over somebody else's. Okay, investors can further strengthen these relationships by presenting well-prepared proposals for each deal. So if you got a deal, you want to describe it, document it, show all the highlights and of the deal and why they should borrow you the money. I have what I call a credibility kit, which is available for sale, which kind of provides a template on how you can present yourself to a lender. It kind of tells your story, who you are, what you've done, some of your experience, and why they should lend you the money, and so on. So you can check that out on my website, www.joeasamoah.com. So, obviously presentation is important. Also, you want to highlight the property's potential, your investment strategy. Are you a buy and hold? Are you a BRRRR? Are you a fix and flip? What's the strategy? And how, your financing is going to align with their goals. Okay, so this approach that I'm suggesting not only instills confidence, but also positions you as a credible and a serious partner. Okay, so and the personalized touches such as insights about your long-term vision, what you envision for this property, what you see the outcome of the project, and demonstrate your market expertise. I think only helps on your part. Okay, so another thing is consistency. Building a track record that shows that you've done this before, you've got successful projects under your belt, and you've shown and demonstrated timely repayments. These are all things that can lead to better terms and opportunities for future financing as well. So banks are more likely to extend favorable terms to investors who have proven themselves to be reliable over a period of time. So reliability creates a foundation that can open doors to higher credit limits, faster approvals, and hopefully more flexible loan terms. So what are some of the action items associated with what makes a strong banking relationship? In my opinion, a couple of things. One is maintain accurate and up-to-date financial records. Have your documents lined up, your statements, your balance sheets or personal financial statement and things like that, your credit report, have all that lined up so that way you can show it and have it available if need be. Communicate proactively with your lender about your investment plans, what you intend to do, and also build a track record of successful projects that you've had under your belt, because it all adds up to your credibility. Okay, number two. So number two is how to choose the right financial institutions. How do you choose the right financial institutions given you have your financing needs? So I suppose the question is, what factors should investors consider when selecting a lender? What should you consider if you're selecting a lender? What differentiates one lender from another? and why should you go with A versus B and B versus C and so forth. So choosing the right bank or financial institution is really critical to your success. The reality is that different lenders specialize in different types of loans. They're not all the same. Some have expertise in certain areas, which can affect your ability or impact your ability to secure financial terms. For example, some banks may excel at what we call DSCR, debt service coverage ratio type loans, while others may specialize in fix and flip loans, renovation financing, mezzanine financing, sort of bridge financing. So there are different um, types of institutions to the different types of products or loans that you're looking for. So selecting a lender that aligns with your unique investment goals, what you're trying to do, ensures a smoother collaboration. And in response to that, you should sort of evaluate the bank's responsiveness and willingness to work with real estate professionals. Not all banks are pro real estate investors. Some of them are some of them are not. And you want to look for institutions that understand your market and investment strategy, as they're more likely to tailor their offerings to what you're looking for. So consider factors such as turnaround time, how long does it take, the flexibility of their terms and conditions, and also the customer service quality. So don't hesitate to shop around and compare rates and terms, and also customer service. So local community banks, small banks, and credit unions often provide more personalized services and flexibility compared to the big box national banks as well. So there are pros and cons of different institutions, different lenders, and you may want to select one that makes the most sense to you. So combining relationships can create, give you more options in terms of diversified, offerings. So what are some of the action items associated with choosing the right financial institution? One, obviously research lenders that specialize in your preferred investment strategy, what you're looking for, whether it be BRRRR, fix and flip, buy and hold, and so forth. Compare rates, terms and conditions, and customer service across multiple financial institutions, and consider working with both local and national lenders to diversify your options. Okay, number 3, moving right along. So don't forget, number 1 we talked about was what makes us a strong banking relationship. Number 2, we talked about how to choose the right financial institutions. And number 3, we're going to talk about building a winning proposal. Proposal that will let the lender know that, hey, this is the deal that you're bringing to the table, and hopefully they'll fund it. So the question is, how can you present your deals effectively to lenders? How can you effectively present your deals to lenders? Well, a well-crafted proposal or a document is really important to securing financing. Okay, start by clearly outlining the property details, including its current conditions, the purchase price, potential after repair values, and what's it going to take, or even future rents, and so forth. Highlight your investment strategy and the expected cash flow if you're going to hold on to it, showcasing how the deal aligns with the lender's criteria, what they're looking for. Okay, so presenting your proposal in a professional and concise manner can really leave a lasting positive impression, because sometimes the first impression is always the lasting impression. So if you go there knowing what you have to do, presenting your information carefully and succinctly, it's always a good thing. So supporting documents such as things like business plans, overviews, financial projections, and comparable market analysis, CMAs, can also add credibility to your proposal. So be prepared to address potential risks and how you plan to mitigate some of those risks. I mean, it's not always smooth sailing. Things happen. You don't want to go there pretend everything's going to be all hunky-dory or 100%. Life happens. There could be a curveball that's thrown on you. So you want to be able to talk about some of those things on your document. What happens if interest rates go higher? What happens if the tenants don't pay you on time? What happens if the rehab is takes longer or it's more more expensive or more costly than what you envisioned? What are these? What are you going to do? What are some of the plan Bs and alternatives should these situations occur? I think if you put them in, it lets people know that you got a plan A, plan B if curveballs are thrown at you, and which I think is impressive, as opposed to just pretending everything's going to be perfect. I think it demonstrates professionalism, and also increases the likelihood of you getting approval. So include visuals if you can, property photos, renovation plans, because I say a picture paints 1,000 words. Sometimes you can, good photographs or good summaries, graphs are more effective than just reams and reams and paragraphs of written text. So tailor your presentation to the lender's preferences. You have an idea what the lender is looking for, so you adapt your presentation accordingly. And some lenders, for example, prioritize cash flow, while others focus on equity or long-term appreciation. So depending on the lender, you may want to highlight certain things and understand that what matters, you need to understand what matters most to your lender. And that way you can sort of position your proposal accordingly. And so on. So what are some of the action items associated with building a winning proposal? Prepare a detailed proposal highlighting key property details and your strategy. Include supporting documents such as financial projections and market analysis. And then finally, tailor your presentation to align with the lender's priorities. So that's number 3. And kind of midpoint through this thing. So again, if you got some questions, please put them in the chat box and I'll get to them in about 5 to 10 minutes. And if you have more specific questions you want to have me discuss or work through with you, you can always book a one-on-one Zoom with me, where we can do a deep dive into the situation that you're encountering, and hopefully you can leverage on my 35 years worth of experience. There aren't a whole lot of scenarios I haven't been through or serious or experienced, so hopefully I can help you avoid what I call making unnecessary mistakes. So let's get down to number 4. Leveraging creative financing options. So I suppose the question is, what alternative financing solutions can lenders provide? What are some of the alternatives? Should your plan A or plan B not be appropriate? So beyond traditional loans, banks and financial institutions can offer various creative financing solutions to support investors like you and I. These include things like lines of credit, construction loans, bridge financing. These are sort of more creative loans. If you need a home equity line because you got a lot of equity in your property, you could tap into that equity such that you can do other things with it. I mean, I've got several home equity lines of credits myself. So they're really, really useful. And but you have to have discipline. So that way you don't sort of, blow up the line of credit and then put your property under potential, a sticky situation. So, lines of credit, for example, they provide for quick access to funds for unexpected expenses or any potential opportunities, especially time-sensitive deals that require you to execute real fast. Construction loans are ideal for renovation-heavy projects, while bridge loans, can help finance a property until long-term financing is secured. So portfolio loans are another valuable tool. And these allow investors to consolidate multiple smaller loans or multiple properties under one loan for simplified management and improved terms. So the idea is that you may have a loan on property A, another loan on property B, another one on property C, and a sort of a portfolio loan, can put all those together and just get one loan. And so I haven't done a portfolio loan, but it's something which I did explore, a few months back. So developing strong relationships with your lender can also lead to customized solutions that align with your unique needs, such as whether you need a portfolio loan or interest-only payments, etc. So by building trust, you position yourself as a reliable borrower worthy of tailored financial support. Again, it's all about trust. If they trust you and you understand what their criteria is, what they're looking for, you stand a much better chance in terms of getting the financing. So action items associated with leveraging creative financing options. Explore financial options beyond traditional loans. Discuss your investment goals with your lender to uncover tailored solutions, and also use creative financing strategically to scale your portfolio. And then go to number 5, overcoming challenges in banking relationships. Overcoming challenges. There will be challenges. The question is, what common obstacles do investors face, and how can they overcome them? What are these challenges that you're more likely to face, I faced, you'll face, will face on our journey towards developing and growing our portfolio? While building and maintaining strong banking relationships is not obviously without challenges. It's not easy. Things go wrong. Common obstacles include strict underwriting criteria. Okay. Communications gaps, where they're not responding, and also things like changing market conditions. These are things that happen, and they could be problematic for you. So to overcome some of these issues, investors must remain proactive and adaptable. You got to be able to adapt or change based on the realities of the marketplace. So anticipating these challenges and addressing them head on strengthens your credibility with lenders. If you can sort of talk about some of the possible problems or curveballs that you could experience, and then how you intend to overcome those things, it really does build credibility. It tells people that, you know what you're talking about, and you have the ability to adapt given if the environment changes. So regularly updating your lender on your portfolio's performance and financial health is also good. It can help build trust and keep the relationship strong. Communicating is always a good thing. So if you encounter difficulties such as delayed payments or unforeseen setbacks, again, communicating openly and working with your lender to find solutions is also a key. So being transparent during challenging times demonstrates commitment to maintaining a positive partnership with your lender. So building a relationship with multiple lenders can also help mitigate risks and ensure access to financing when you need. You don't put all your eggs in one basket in terms of one lender. You develop relationships with multiple lenders, such that if one, doesn't want to give you the money, you still have options to go elsewhere. So by diversifying your financial network, you reduce your dependency on a single institution, and also creates more opportunities to negotiate better terms. So what are the action items associated with this one? Overcoming challenges and in banking relationships. One is maintain regular communications with your lender. Be transparent about challenges and collaborate on solutions, and also diversify your lender relationships to reduce dependency on a single institution. And then finally, number 6, learning from experienced investors, learning from others who have been down this path before. As the saying goes, a wise man learns from his mistakes, but a genius learns from other people's mistakes. So what lessons can you learn from seasoned real estate investors who have been down this path? Well, experienced investors often emphasize the importance of patience and also persistence. It takes time, and sometimes you'll get turned down, and you have to try again. You have to be persistent, especially when building solid, strong banking relationships. It's important because relationships are the key to these things, and learning from other people's successes and setbacks can provide valuable insights into navigating the complexities of real estate financing. So their stories, other people's experiences, hopefully will illustrate how a single strong banking relationships can lead to ripple effects of opportunities. And seasoned investors also stress the importance of staying informed about market trends and what's going on in the regulatory environment. So this knowledge allows you to adapt your strategy and maintain strong relationships with financial partners. So by staying ahead of the curve, you'll ensure that your investments, continue to be aligned and strong and likely to stand the test of time in an ever evolving financial landscape. So by studying the experience of others, new and intermediate investors can avoid common pitfalls that many people have. And also, you may want to consider, mentorship opportunities, so you can go under the wings of other people who are a bit more experienced than you, and can also share with you some of their lessons learned. So in conclusion, the point is this about building your financial foundation. Building strong relationships with banks and financial institutions, in my opinion, is absolutely essential for any real estate investor aiming for long-term success. Okay, these partnerships provide you more than just access to financing. They also create opportunities to secure creative, tailored solutions that aligns your goals with the financial institution's goals as well. So with the trust and backing of reliable lenders, you can unlock really competitive rates and faster approvals, and hopefully support during challenging times. So establishing trust with lenders requires that you are consistent, transparent, and also proactive in terms of communicating with them. So by presenting well-prepared proposals and maintaining open communications, you demonstrate professionalism and reliability, which really are key to diversity, long-term, at least fostering long-term relationships. And so take the time to cultivate and strengthen your relationships with financial institutions, and you'll gain significant advantages in building a profitable, hopefully, and resilient real estate portfolio. There, my friends, is today's Wealth Wednesday topic, and we're going to go down to Q&A. So if you've got some questions, please put them in the chat box, and I'll get to them in a couple of minutes. Anything to real estate investing, if there's anything that you want to leverage on my years of experience, please put them in the chat box, and I'll try and get to them shortly. If you want to shoot me an email, you can reach me at joe@joeasimo.com, joe@joeasimo.com. That's my email address. And likewise, to book a one-on-one with me, feel free to go to my website, www.joeasimo.com, www.joeasimo.com. Again, if you got some questions, you want to put them in the chat box, please put them in, and I'll get to them shortly. For those people who want to really develop your skills in terms of tenant screening, I do have a tenant screening playbook course that you may seriously want to do it. My experience is that getting the right tenant into your property is absolutely the make or break for you as a buy and hold investor. If you have a good tenants who pay their rent, take care of your property, no drama, and hopefully looking to stay a long time, then you will be doing great. If you have problem tenants, it's a tough business. So check out the course. Go to my website, or go to this website. It's called www.screeningplaybook.com. That's www.screeningplaybook.com. And then you can check out the course. It's a really good course, And it goes to a lot of details about how to do this the right way, how to attract what I call tier one tenants. So hopefully you won't have the drama that other landlords have. So let's get down to the questions. And chat box. Greetings from Phoenix. Wishing you a happy new year, Dr. Joe. Yes, my I extend it to you as well. Hope you had a wonderful Christmas time, and hopefully that you're going to have a wonderful 2025. Hope 2025 is going to be a marquee year for you, Dow too. Okay, Samuel Mojai. Hopefully I spelled that pronounce that well, Samuel. If I didn't, apologies. What to do if you're not able to refinance after a BRRRR? Oh my goodness. What can you do if you can't refinance after a BRRRR? Okay, so the idea is this: you bought a property, and you've made some improvements to the property. You found a tenant, and now you want to refinance. And in Samuel's case, he's unable to refinance for various reasons. The typical reasons are the ARV is not there. 2, your credit shot, so the lender won't lend to you. 3, maybe you have difficulty finding the tenant. Another one is that the rent that you're getting is not high enough to allow you to pull most, if not all, your cash. So what do? It depends. It depends if you had short-term financing in place, like a hard money lender. If you have a hard money lender for the acquisition and renovation, then typically it's a higher interest rate, which means that you don't want to keep that loan for too long. So what I would do is, obviously, if you can't refinance, find out the reasons why you can't. If it's something to do with you, i.e. your credit or the numbers don't pan out, then you may want to get a credit partner, somebody who has the credit experience and who may be able to qualify for financing that you can't do. Another option you're going to do is that you may not be able to pull out all the money that you're thinking of because the ARV is not there. And in that case, you're going to have to leave some money in. And another option for that one is you get what I call patient money. People who are okay not having their money back for 1, 2, 3, 4, 5 years, and therefore you can replace the money that you have got tied up in the property with their money. In essence, they give you the money, maybe in the second position, and then that allows you to extract your funds so you can do your next deals. You don't have all your money tied up into the property. So I'm not too sure what your situation is, Samuel, but there's always a way around it. And but I just need to better understanding what the issue is and why you're unable to to refinance. Related question: what to do if the house doesn't appraise? It doesn't appraise enough to pay back your hard money lender, and you don't have the money yourself. Oh my goodness! So I think what Sammy's saying is that he's done a project, and it just didn't appraise. My question would be, why this, after completing the project, is not the best time to find out it's not going to appraise. You want to do your due diligence before you even bought the property in the first place. Again, but you didn't do that, or somehow the market maybe turned on you from when you bought the house to what it is today. But the bottom line is that the appraisal is not high enough. So, and it sounds like the appraisal, the amount of money you're going to need to refinance or pull out is going to be less than what you've got in it or what you borrowed through your hard money lender. So, what are you going to do now? So you got a couple of choices, really. One would be, as I said before, get a credit partner, somebody who is patient, doesn't need their money today, and hopefully can plug the delta between what the appraisal, when you do the refinance, you're going to get versus what the hard money lender has on the deal. So they'll borrow you the money as a private investor, and then obviously you're going to have to offer them something that's attractive to make it worth their while. Maybe a second position, maybe better interest rates, and so on. So that's one thing you can do if you don't have the money yourself. The other option is obviously just have your money tied up in the house, because you got to pay the hard money lender off. Otherwise, you're going to be paying that 10, 11, 12, 13, 14% interest rate, or they may say that you're in default of the loan, and so they may foreclose on you. So you got a couple of options, Samuel. It's not easy what you're in, but you can get through it. Book us a one-on-one session if you want, and we can do a further deep dive, and I can sort of give you my thoughts on some strategies you may want to consider. Charles. Hey, Charles. Hope you're doing well. Awesome Wealth Wednesday. Do you have experience with seller financing? If so, what are strategies or negotiating tactics to convince sellers to do seller financing? Boy, seller financing. I know the gurus tell you, sellers will gladly do this. But in my experience, that most sellers, all they want is their money. They don't want to carry a note. They just want to move on with their life. Now, there are some sellers who are okay with taking seller financing for maybe tax reasons. They don't want the money, but they want the regular residual income. So I mean, another one is subject to. I've done several of those subject to. Subject to allows you to take over the existing owner's financing. And so that way you don't have to get a new loan. And then you pay the seller something to move on for the equity that they may have. So, again, it depends on the seller. Not all sellers are open to subject twos, but some of them are. And I've done several subject twos. So it's going to depend on how you position it to them, how you articulate it to them. You got to obviously think about what's in it for them. Why should they do it? Why should they do it with you? Are you reliable? Are you honest? Are you ethical? Are you going to be around so that way they can get there? Because they're allowing you to take over a mortgage. And if you don't pay, it's going to be on their credit. So again, how do you demonstrate to a lender or to a prospective seller that you're going to do the right thing? It's all about credibility. I would suggest that you consider a credibility kit, a template that sort of describes who you are, what you've done, your experience, why they should lend to you, and what makes you different from everybody else, and how they're going to get their money back. So these are some of the things you may want to consider. I do have a credibility kit, I think, platform product on my website. So you may want to consider checking that out, Charles. Hopefully that helps. If not, just throw back another question. Marlon, hey, happy New Year. Marlon, hope you're doing well where you are. Hope 2024 was a good year, and I hope that 2025 will be an even better year for you and your family. In terms of we're off to Ghana, I think, at the end of this month. I'll be going there for a couple of weeks. See my brother, my sisters, and my mother. I have a little family reunion in Ghana at the end of this month. And I think I'm going to Trinidad in February. They have a carnival over there. So I'll be going to that one. And I was invited yesterday to be a guest speaker at a real estate conference in Cancun, the end of March. So I'll be going to different places in the first quarter. My goal is to get to at least 5 countries this year. God willing, I'll be able to go to at least 3 by the end of March, and so on. So hopefully it's going to be a good year. Okay, if you've got some questions, please put in the chat box and I'll get some to you. I'll get to them. Ty, Happy New Year, Dr. Joe. How many different loan estimates from different financial institutions do you typically get, or do you have to go to a lender you always use? Okay, I'm going to read it again. Happy New Year, Dr. Joe. How many different loan estimates from different financial institutions do you typically get, or do you have to go to a lender you always use? No, I think that it's worthwhile to shop around. Nowadays, there's lots of different options for you in terms of getting money. Obviously, you got the traditional stuff like the banks, financial institutions, commercial lenders. There's a lot of these DSCR, debt service coverage ratio lenders. There's hard money lenders out there, and so it's worthwhile to shop around, develop relationships, get to know people, get them to understand who you are, what you're trying to do, what differentiates you from others, why they should lend you money, demonstrate that you're a good risk, demonstrate that you're a reliable person, you know what you're doing. So you don't want to put all your eggs in one basket. And so I would suggest that if you don't need the money, now's the time to start. You got some time, and nurture those relationships. And when you do need the money, you'll have all that stuff in place. So I would suggest that, to answer your question, maybe 2 or 3 different lenders you may want to approach initially. And out of those conversations, hopefully you'll have a good feeling about an institution, a lender, and they about you. And they feel like they want to do business with you. You want to do business with them. Their terms and conditions of their money appears to be reasonable. Then when you got that, then, do a deal. So I try to nurture relationships with 1 or 2 institutions, and then that way I don't put all my eggs in one basket. And just in case I unable to come to terms with lender 1, I can go to number 2, and so forth. I don't recommend that you burn bridges. If you don't use one lender and you decide to go with somebody else, still keep the relationship, explain why, and hopefully next time round they'll be there for you. Let's have a look. All right, Amon. Thank you, Dr. Joe, for the weekly helpful insights. You're welcome, Amon. Hope today's session is helpful. It's now 7:43. I'm going to kind of wrap it up early today. So if you got some questions, put in the chat box. Otherwise, I'm going to wrap up a little early. Try to get a little nap. It's been a action-oriented day today, and pretty lousy week in terms of the weather. But hopefully, it's going to get better. But I'm looking forward to 2024. What are your goals? Share with me some of your goals that you have. And some of your accomplishments that you did in 2024, and what your plans are for 2025. Please share them with me. I would definitely more than happy to hear them. I've shared with you what I'm doing. I plan to do a lot more travel this year, overseas especially, and just as they say, enjoying the fruits of your labor. At some point, you need to enjoy this stuff. Otherwise, what's it all about? I was listening to a podcast this morning, a really, really good one. It's called Founders Podcast. It's really, really good. I listen to that all the time now. It's just good to learn from other people, especially people who've been successful, and what strategies they used, and why did they become where they are, some of the setbacks that they that they endured, and how they overcame them. And I'm definitely implementing a lot of those things to my business. One of my goals this year is to run it like a business and put systems in place, develop relationships with my tenants whereby they're going to be great tenants. I told all my tenants my goal this year is to be the best landlords they've ever had. I told all my tenants. I gave all my tenants Christmas gifts. I reached out to them a couple of days ago when it was snowing, just to make sure they're okay, checking in with them. And, I spoke to several of them yesterday, and just thanking them for staying with me. And my goal is to be the best landlord they've ever had, the best landlord that they've ever had. And I'm definitely going to put some strategies together, because I realize that if you got good tenants, and the relationship essentially is the firewall. The relationship is what differentiates you from other landlords. The relationship is what's going to develop loyalty towards you. and will stay with you. And so if other landlords start, trying to poach them, the relationship that you have with them can sometimes, want them to stay with you because they know you, they like you, they trust you, and so on. So yeah, it's gonna be a good year. I'm looking forward to implementing some really, really creative strategies for developing relationships, customer service with my tenants. I want zero turnover this year. Zero. I don't want anyone to leave. My longest tenant was the 28th anniversary was last week. She's been with me 28 years. 28 years, my tenant. And I was looking through. I got another one, 21 years, 18 years, 15 years. I mean, this stuff works. And if you think about how much money I've saved by not having turnover costs over that period of time, it really does add up. So I'm Ty. I'm hoping to achieve my first Section 8 rental this year. Oh, fantastic, Ty. Hopefully, if I can be of assistance to you on that journey, please let me know. Again, if you got some New Year's resolutions, if you got some goals that you want to accomplish in 2025, feel free to share them with me, and maybe we can have a little accountability here. I want everybody to at least do one deal this year, at least one deal. Let's do it. Okay, Marlon purchased another property in 20. Okay, so you purchased another property in 2024, and for 2025, focus on using more systems to help with self-management. Okay, sounds good. Congratulations on your acquisition in 2024. You're building your empire, Marlon. I'm very proud of you, very happy for you. And hopefully you continue on that journey in 2025 and use more systems to help with self-management. Yeah, self-management. I manage all my properties myself. It's, it can work. And it's a I don't know, it's a pleasure. I really enjoy it. I really, really do. I love being a landlord. I know you think I'm crazy, but I love it. And you're making money, but also you're making a big difference, a huge difference in other people's lives, and that's what I like about it. Samuel, your goal is to, again, if you got some goals, put them out there here. Let me hear them. Share them with me, and let's see what I want to hear your goals. Where would you like to be this time in 2026? So Samuel says, to do my first successful BRRRR, my question wasn't from experience, but thinking of the worst case scenario. Okay, so okay, I got it. So it wasn't the scenario you gave me earlier on, which is that you couldn't refinance, was the worst case scenario. It may not be what you've experienced personally, but it definitely has happened to some people whereby they've done the entire project and their ARV is less than what they thought, or it took longer, their expenses was higher, and these things happen. And but again, I would suggest that you before you do your first or your next BRRRR, is to make sure you do enough due diligence on the numbers, to make sure you're not overpaying, make sure that the rehab costs and estimates are correct, developing a good team, developing relationships with contractors, and then do an analysis on the numbers in terms of the rents that you're likely to obtain. I do a lot of Section 8s, and the rents with Section 8 is usually very tied closely, to the number of bedrooms in the house. So I have a good idea what I would likely to get from rent. So you want to do that due diligence as well to make sure that what you're going to collect in rent is in fact realistic. And also, again, what's the ARV for your area, such that hopefully you avoid making those mistakes that you talked about, whereby you're unable to refinance for whatever reason. Okay, Ty, amazing. I don't know anybody who's had a tenant longer than 3 years. 3 years. I'll definitely reach out to you regarding Section 8. No, 3 years, that's nothing. I'm looking for, I tell my tenants when they move in, hey, I'm looking for you to stay here for at least 5 to 10 years. None of this 1, 2, 3 nonsense. I'm talking for 5, 10, 15, 20-year tenants. That's what I'm looking for, and that's who I target. Because transient, turnover is very, very expensive when they leave. It can wipe out a lot of your cash flow. So I screen. I want long-term tenants. That's who I'm looking for. They know that. That's what I'm looking for. And with Section 8s, I can consistently get that. Consistently, because a lot of these families, they don't want to move. They want stability, especially if you've got a nice house in a nice area. You can appeal to these families who want stability, and they just want to stay a long time. I've got another one coming up soon. I'll show it to a prospective tenant. She says she wants to stay there forever. We're talking 20, 30 years. She wants to be there. This is her dream home. A dream. If I gave it to her and she, if I offer it to her and she gets it, she said that's her dream home. And that's it. That's the end of the journey. She's not leaving. So that's she wants to stay there forever. So that's the kind of people that are out there, and that's the kind of people you need to attract if you want to get into this buy and hold strategy. DCC, can your systems be robust enough to allow out-of-state non-DC folks to be long-distance landlords in DC? That's part one. Part B is, how transferable is your Section 8 approach, say Houston or another city not in the DMV? Well, Section 8 is a federal program. And so there is a housing authority in every jurisdiction within the United States. It's the largest program. It's like $135 billion allocated to this program. I've been doing this for a long time, 35 years. It doesn't matter the administration that's in. This program always seems to continue to grow. So I'm not worried about the new administration coming in. The bottom line is this: it's cheaper to pay me rent than it is to have a family of 5, 6, 7 homeless. That's the bottom line. So this program is going to be around. It's not going anywhere. No one knows tomorrow what's going to happen tomorrow, but my experience is that Section 8 program is still going to be there. There's a need for it. These families are here. They need to be housed somewhere, and it's cheaper to have them pay rent than it is to have social services and homeless people, and with the financial cost of that and also the social cost of that. So anyway, so it's a federal program. And can it work outside of the DC area? Definitely. What I'm sharing with you, it's really a tried and true and tested system. The reality is that most Section 8 families are stigmatized. Society looks down on them. They feel that when landlords hear the word Section 8 voucher holder, it's usually negative. And so they're usually concentrated in the worst part of town. Crappy houses in crappy neighborhoods with crappy landlords. That's how I describe it. And a lot of these, what I call tier 1 tenants, and the tier 1 tenants are everywhere, not just in DC. They're in Houston, they're in Dallas, they're in Chicago, they're in New York, they're everywhere. These are people who want to live in a decent house in a decent area and rent from a decent landlord. They are everywhere. And there's a lot of them out there whose needs are not being met. And that's where the opportunity arises. So I think you can put some of these systems I've been talking about for the last several years into place there. You can clearly differentiate yourself from your competition, because the competition is very, very weak. Most landlords do not agree with my philosophy. Most landlords, all they want is their money. They don't care about the tenant. As long as they don't see the tenant, hear from the tenant, they're cool. My feeling is that there's a lot of good families out there whose needs are not being met. So, hey, there's the opportunity, DCC. And it could be implemented across the board. And book a one-on-one with me. And I'll be more than happy to go in more detail. If you want me to help you implement your strategy locally, I'd be more than happy to do so. We can work something out. But yeah, it does work. How do you determine a community on a path to gentrification? It's pretty straightforward, really. Good question though. If you live in a town, certain trends are pretty clear, and it may be the path of growth is from east to west, or south to north, or whatever it is. There's usually a path in your city or your community where as you move from east to west, for example, prices tend to go higher. The better areas, east to west or west to south, whatever it is, there's a path. And the people who want to go west, at some point they can't afford that, so they go a little bit more east, where it's a little cheaper. If they can't afford that, they go a little bit more east again until they can afford it. And over time, people who get priced out of the high expensive areas move a bit more east, and then over time, you're on that path. So in the Washington, D.C. area, for example, it's heavily east to west, and it's also connected to the subway system over here, and so on. So in your community, wherever you are, there's usually people who know that area, people who've been around, real estate agents, appraisers, property managers. They'll tell you the neighborhoods that are on the path. And sometimes if you can't afford that area, then you go somewhere else, and then just hold on. At some point in the future, it catches up to you, and so on. So that's what I call path of gentrification. Amen to using brilliance to restore dignity to downtrodden, high aspiration people. You are lifted. Yes, there are families out there who are yearning for an opportunity. They're yearning for people like you, DCC, to give them a chance. They're out there. And you definitely, there's ways to do this. I think Section 8 is the greatest program ever created. It's a fantastic program once you understand how it works. And I mean, where we are, we're getting rents of $3,000, $4,000, $5,000, $6,000. There's no way you can get people who are prepared to pay $3,000, $4,000, $6,000 and looking to stay 5, 10, 15, 20 years. That's impossible with market renters, because at some point, if you're paying $3,000, $4,000, $5,000, $6,000, you're going to say, to hell with this. Let me go buy my own house. That is unlikely to happen with the voucher holders. And that's how you can get people who stay 5, 10, 15, 20 years. They just have a different perspective. But it's a different program, and it's a great program. And I highly recommend that you consider learning more about it. And again, book a one-on-one with me if you'd like me to go into more detail about it. So again, it's about 8 o'clock now. So again, you can email me, shoot me an email at joe@joeasamoah.com, joe@joeasamoah.com. If you want to book a one-on-one with me, go to my website, www.joeasamoah.com, www.joeasamoah.com. And then, we'll do a one-on-one, and hopefully I can, help you on your journey. So with that said, my friends, I'm going to wrap it up for the day. Have a good evening. I'll see you next Wednesday. Take care. Bye for now.